Welcome to another fantastic episode of Finance Footnotes. I'm your co-host, Brent Stransky, here with my friend and colleague, Zach Miner. And we're going to talk with you today. First time we've been back in a few weeks, but we're excited to share with you some details about what's going on in the marketplace. It's been the first meaningful pullback so far this year. Markets are off from all-time highs. I'm going to share with you a little bit about where the markets go from here. I want to talk a little bit about sentiment, and I want to talk finally a little bit more about what we're going to see going on in the future with some of the volatility that we're seeing in the international wars that are taking place. So that's what I have on the agenda for today. Zach, what do you have in store for us?
Yeah, I'm going to take a look at some kind of intro to some election-themed things, really around wealth in generational terms. So differences in wealth between generations, intra-generations, and it kind of informs how folks are thinking about the economy and ultimately how they end up voting.
There's an election this year?
I think there might be.
Just kidding.
Maybe.
All right, well, let's jump right in then. I'm excited to hear your comments, my friend. But let's start right now, just where we are. So the first chart I have up for us today is just a chart from the Wall Street Journal looking at the three major stock market indexes from left to right. We're looking at the Dow Jones, then the S&P, and then the NASDAQ. And you can see they have had a meaningful pullback here, and meaningful, right? The S&P is off 5% from its highs that were set at the beginning of April. And NASDAQ down about 7%, but you can see all three indexes have fallen through a level of resistance called the 65-day moving average. What does that mean? No one really knows if it's important or not, but it's something fun to talk about if you're a technician. So I mention it here in passing. We are going through a little bit of volatility, and it's certainly been in the headlines based on what's going on internationally. I'll talk a little bit more about that in a second. Any comments on this, Zach, or just kind of observation about where the markets are at the moment?
We've been talking about the kind of the run that we were on for 16 of 17 weeks, 4 or 5 months, pretty much straight up and to the right. You get at least 2 or 3 5% pullbacks a year. 10% pullback you can kind of expect a year. So we were well overdue for it.
And we talked about this last time, and I think we kind of hit the nail on the head. Like, markets are by their nature volatile, and that's why you're compensated for that risk in normal markets. And the
equity risk premium, they call that. I saw a good post today. I forget exactly who did it, but it was essentially kind of tracking the various paths over the course of history for the S&P 500 and showing that there really is no average year, because if there were average years, then there would be no equity risk premium, right? You kind of need the volatility to get the return. So it's certainly not surprising.
Yep. And then what we spoke just last time we were together about average pullback going back the last 40 years is something like 14%. So very normal. Never feels normal when you're in it. But let me ask you this question. Pop quiz, my friend, and for all you folks at home paying attention. The question is this: are you more likely to increase or decrease your equity exposure over the coming days and weeks? So markets are down 5 to 7%. Are you looking to add positions? Zach, what do you think?
Is this a personal, like me personally, or is this like, what do you think?
Take it how you want. This is I'm going to this lead into my next 2 slides, but this is a JP Morgan Wealth Management asks their high net worth investors this every week. And so I wanted to ask you, if here we've got a bit of a pullback, are we going to put money to work? And I think you're probably sniffing at the direction of this question.
Yeah, well, personally, I try to remain pretty fully invested for the duration, have folks allocated properly how they should for their circumstances, their unique circumstances. So I don't necessarily hold cash kind of on the sidelines. I do sometimes raise cash for distributions at certain times in the market. But personally, I'm not timing 5 to 10%.
It's awfully hard to catch a falling knife, as they say.
But I would expect the rest of the market to probably add equity exposure on these pullbacks, because that's kind of been the right thing to do over the last 18 months.
And that's a great point. What people say they're going to do and what they do, as we know, is very different. So this on the next chart here, I have the kind of going back a couple of years here. This is the JP Morgan, their own in-house survey of wealthy people. And hey, at 35%, the current level of people who say they would put money to work is 35%. It's about at the lows over the last 2 years. So people are, they're hesitant, which, as we know, is typically a bullish sign. So
just going back and looking at like when these answers were really high, like February of 22, 80% of people are going to put money into the market. Well, that was, in hindsight, not the best time to do it.
That was when the markets were putting in all-time highs, and then 2022 was a pretty negative year. So, and then you look, looking towards the beginning of 2023, which turned out to be a good year. The exact opposite. So, we tend to make mistakes from that sentiment. I wanted to lead into the next chart, which isn't as positive. We've talked about this before. This is one of my favorite charts. There's no metric that's right all the time, but this is the market sentiment, the Citigroup panic euphoria. My God, euphoria model. I can say it, I promise. And this is really cool. This is a really great chart. It's hard to read the very fine print here, but the reason that's important is the fine print here at the bottom. And this is from Barron's. They post this twice a month in their newspaper. The panic euphoria model is a gauge of investor sentiment, identifies panic and euphoria. Levels are statistically driven by buy and sell signals, etc. Historically, this is the important part. A reading below panic, and that's the green area there, is a better than 95% likelihood stocks will be higher in a year or more. While euphoria, that's the blue area, which we just peeked into, is why I wanted to highlight this, generates a better than 80% chance of probability stocks will be lower a year later. So
yeah, that's a great indicator. I wonder how far that goes back. I don't know if you know offhand.
It goes back many years, at least as long as I've been looking at Barron's. I would say it's at least run for 10 years. And from my humble experience, which is not, I don't have it popped into an Excel spreadsheet, but it seems to me to be relatively accurate in terms of, if you look, just a year ago, like we were just saying, a year ago, there was a panic in the marketplace, last March and April timeframe, things were, bottoming and then improving, and people were in panic stage. So again, we'll have to kind of hold our breath and see what happens here.
Yeah.
But at least this one good index is suggesting, hey, it might be volatile going forward. So we'll continue to follow this, folks, as we go forward. Moving on here. I saw this in the newspaper today in the Wall Street Journal. I thought this was very interesting. Or maybe it was Barron's. I read so many intelligent sounding periodicals, it's hard to keep track sometimes. But that being said, I want to talk about easy money because, inflation has come in, exactly we talked about last time, and a little bit, hotter than we hoped for the last 3 months, and that puts pressure on the Federal Reserve to keep interest rates high. Okay. And there has been dialogue that's crept into the marketplace about, gosh, maybe rates are going to increase from here. Now, I think that's still an outlier. And would you agree with that?
It's becoming less so.
It's becoming less so. So I saw this article and it's talking about the easy money policy. And correct me if I'm wrong here, Zach, you're the CFA, but it seems to me that this indicator, the financial conditions are easy. This is the Federal Reserve Bank of Chicago, and we're looking at a chart here, and we're looking at a neutral rate of 0, and we're currently, we got close to that level of 0 from a negative place a year ago, and now we're kind of decreasing again. And I believe this suggests how much the Federal Reserve Bank would have to, change rates to get to a kind of a neutral rate for the economy. And that would suggest they'd have to raise interest rates again by, up to maybe 50 basis points, according to this model, meaning that money is easily available, readily available for folks that need it to grow their business or to put on a home edition or whatever. Is that your read on this?
I don't think it's basis points. I think it's an index to 0 to kind of taking a bunch of different factors and determining whether or not the monetary conditions in the economy are considered tight or restrictive. But I put out my quarterly letter recently and highlighted a couple things where you have a record number of people expecting to take an international vacation. You have construction employment at all-time high. You have restaurant expend at all-time highs, and just these aren't the things that you see. These aren't the indicators that you see when monetary policy and when the economy's tight. These are things that you see when it's loose, and I think you're starting to have that outlier creep in where Bank of America did a survey about a year ago or at the beginning of the year, where they said what would rates going to be at 12 months out. And 9 out of 10 said lower. 9 out of 10 fund managers, these are professionals, that said they would be lower. And that's starting to creep in, like, well, maybe they actually won't be. Because if you're talking about a Federal Reserve that is supposedly data dependent, and they've been saying that the whole time, we're going to let the data lead our policy. There's no data to support them cutting rates. Inflation's still high, and the economy's still pretty much, things like this, pretty easy conditions. So
I'm pulling a Zach here. I'm adding in a chart real time. It's just To you
Love it.
folks at home, it's you won't see it, but I'm going to just quickly add a chart here for Zach to see as we're going through the live here. This is just a interesting point. Yeah, things are kind of so the point of my previous chart, and to build on what Zach just said, is that the conditions in the economy are as easy as they were, according to this one index, as when the Federal Reserve Bank started raising interest rates in January of last year. So take that for what it's worth. We'll have to see what it means. I just added a chart here, Zach. Hopefully you can see it. This is credit card delinquency. And, at the same time as people are spending more money on international travel, which is surprising, credit card delinquencies. This is from the Federal Reserve Bank of Pop Quiz, the Fred Bank of St. Louis. Just kidding. Yeah. So you can see here in this particular chart, credit card delinquencies, which they measure every quarter, as of year end, was at 3.1%. And I believe they just released this in the last, actually, what does the data say on there? But it just released recently as the
Q4,
and the updated at the and they updated at the end of February. So you can see though, this is the 10-year chart. It's the highest it's been. It had fallen to about 1.6%, which is the lowest it's ever been. And then it hasn't been this low in 15 years since the credit crisis in 2009. So a little conflicting data there, I guess.
Certainly is.
Cool. So just two more charts for you folks, and then I'll turn it over to our friend Zach. I just want to highlight one chart here. Markets during elections, we're coming into what appears to be a soft stretch here for markets in the April, May, and possibly part of June timeline. This is from our friend Ryan Dietrich at Carson Wealth Management. He posted this on Twitter last week, and I thought it was interesting. Markets tend to be sluggish for whatever reason, and the chart here is specifically about election years going back to 1950, and you can see that there is a kind of a pause here before markets grind higher through the summer and fall of the year. So hopefully there's brighter days ahead. We'll have to wait and see.
It is interesting though, if you kind of look at that average path. We could have front run that, in the beginning part of the year, because if you look at this, this blue line here, by the time you get to June, you're essentially flat for the year. We've kind of, S&P still up 5% for the year, which would be the end point of that September rally. So it's possible we front run that, pulled it forward into the first quarter, and maybe the rest of the summer will be similarly to what the blue line looks like from January to May. So, just something to think
Time
about.
will
It's
tell.
Possible that was pulled forward. Yeah.
Time will tell. And we'll, of course, keep you posted here on Finance Footnotes, all the important information about your financial lives. Last chart I have for you today that I want to share with you. And Zach, this is really a question for you, but a question for folks at home as well. If I told you a year ago or 10 years ago that two of the perennial powers in the Middle East were going to, for the first time ever, lob hundreds and hundreds of missiles at one another and taking what was a proxy war and making it a hot war, and oil, the price of oil, what would it do? I believe the knee-jerk reaction would be it's going to go well above 100, probably closer to 150. The next chart I want to share with you is and this is not to dismiss the violence and the pain that's in that part of the world, but if you look at this chart, which is from CNBC this morning, you can see that oil peaked at $87 a barrel. And in light of all the conflict in the world at the moment, I think this is just surprising. I think it speaks to, of course, the production that's happening here in America, the largest exporter of oil in the world at the moment for the last 6 years. I believe that's a major index, a major factor in the index. But yeah, oil has since fallen as of this morning closer to $82 or $83 a barrel. So in spite of all the conflict, all the headlines, all the, if it bleeds, it reads, oil has remained well below $100 a barrel.
Yeah, I mean, it would have been definitely a different situation 10 years ago. The fracking boom in the United States really started taking off in 2014. I think that was the last time we saw oil north of $100 a barrel. And, this does certainly speak to the fact that the United States is the world's largest producer of oil. Now, we still import a decent bit because of just the different qualities of oil that's out there and kind of what it ends up becoming. But as natural gas is the same way, where the United States is now the world's largest producer and one of the.
I think natural gas is well below $2 a unit.
Yeah, the chart certainly speaks to the fact that OPEC and these Middle Eastern countries, Russia included, just have less of a say, not a say, but less of an influence on the global oil supply because of the United States production. And it was really interesting though, because I was watching it pretty closely last week when Iran did have that attack on Israel directly from Iranian territory, which is a very different thing than kind of from proxies abroad. Oil went down within an hour of it. There was a quick little spike, but as soon as they essentially released their message that we consider the matter concluded, is what the Iranian regime said, I think the markets and participants kind of looked at that as saying, okay, well, they clearly do not want a direct confrontation with the United States. They had to respond in some way for domestic reasons. But I think that kind of it almost ratcheted down the possibility of a wider regional war, which is counterintuitive and kind of crazy that an attack would actually ratchet something down. But some of the analysts that I was reading, kind of said that their posture and the fact that they had warned some neighboring countries and essentially sent slow moving drones that took 9 hours to get there, basically saying like,
well televised or
like we don't want this to, we don't actually want this to do anything, right? It was more of a show and
it's a wild situation.
Very,
and gosh, I guess my takeaway is that in spite of the headlines, which like everyone else, I was holding my breath for a lot of last week. It was scary at times, and I was kind of surprised to see that oil had this reaction. So that concludes my comments, as intelligent as they were, and handing it over to you, my friend.
Yeah, I'm going to talk a little bit about generational wealth and some of the just what you're seeing as far as political affiliations and protest movements and just the overall sense of kind of angst that I think that you're seeing in our political discourse, certainly domestically, but it also applies in many other Western democracies as well. And I think a lot of it comes back to economics, right? And when you have a stable job and you earn enough income to pay your bills and you have the prospect for your kids to have a better future than you did, your angst level is lower, right? Because you have a situation in your own life that you feel is stable. And I think that's deteriorating for a lot of people. And I took this first chart from Prof G. He's Professor Scott Galloway. Does a great podcast and writes a blog.
What school is he from, Zach?
NYU. NYU. And he put out, I believe this is from his new book, that is focused on wealth inequality, looking at the generation gap and pre-tax income, annual cost of college, and house price relative to income. And those are kind of, three things that are majorly important, to build a stable future for your family. And the youngest generation, the kind of younger millennials, and kind of, I guess you're getting start the very first piece of Gen Z, the older Gen Z kids, just have a much worse time. I have a much tougher time achieving those milestones when it comes to paying for college and buying a home than their parents and their grandparents did. And I think that that's a cause of a lot of just dissatisfaction, and that translates into political dissatisfaction. And I think that's kind of what you're seeing a little bit, between those generations. And this next one is very interesting because it's not a broad brush, because the top percentiles of the millennials are actually doing very well and are doing better than the boomers were at their share of age for their top decile of income earners. And so there's not only intergenerational strife, there's intra-generational strife. Now, because you're kind of seeing a hollowing out of the middle class, the average people. You're seeing a group of folks do very, very well, and you're seeing a group of folks fall underneath, the ability to achieve these things. So this is really interesting because it's not just like, hey, the millennials aren't doing good. Well, not necessarily. There's top 10% of millennials that are actually doing great, that are doing better than the previous generations. But it's that average line where the average person has essentially no wealth whatsoever, where even the average boomer had some positive net worth and some positive wealth and had the ability to purchase a home and send their kids to college. One of the things that Prof G always talks about is his ability to go to UCLA, and I think it cost him like $7,500 a semester or something like that, in the late 70s, early 80s. And that's just not a possibility, at the moment.
Yeah.
The next one just looks at a couple different ways to look at wealth across generations. The chart on the left just has your household wealth distribution by generation. You did see a good tick up for millennial wealth and Gen X wealth after the pandemic, and that was a lot of that was driven by home equity prices that had kind of skyrocketed from 2020. So if you owned a home prior to the pandemic and held on to it through 22 and 23, you certainly did get a benefit to your net worth on that. And then on the right there, we just have the kind of share of the aggregate income that's held by the different kind of classes: middle income, upper income, and lower income. And lower income has remained relatively stable. What you've seen is that a lot of the middle income has gone to the upper tiers, the upper deciles. And that's kind of the theme, is that the hollowing out of that middle class, the loss of ability for the average person to achieve these milestones, in their life and for their families, has really fed into a lot of the political discourse that we're seeing, and the political angst, and the rise of strong men, and the rise of kind of fear-based politics, and fiery rhetoric and all of that thing. That it all comes back, I believe, to these types of indicators, these wealth and income indicators that people feel.
I always, you and I try to peel back the layers and determine, lies, damn lies, and statistics, and see through the haze sometimes. But gosh, that first chart you showed, what is more meaningful to a person's financial life than, your home, your income, and the cost of your education? And I'd be curious as to see if the average and the median were similar, if it's told the same story. But I suspect that that's pretty black and white. And yeah, you can understand why some of these markets, and I hate to call it the education a market, but it is, right? With it's a big business now, and I think it's definitely affecting people's opinion about their future.
Yeah, absolutely. And ultimately the way that they interact with policy and government, and how they vote, and who they're attracted to when it comes to representatives and government. And I think all those things are interrelated. And this next chart is just, it kind of self-fulfills, because you have all this generational wealth that's kind of locked in with the baby boomers. And this is something that both you and I help clients do all the time, right? Is talk about gifting strategies, and how you're going to most efficiently and successfully transfer your wealth to the following generations, how to keep the most within the family as you possibly can, and the least that you can out of the hands of the IRS and Uncle Sam, right? And having these different strategies that you put in place. Well, this is it, right? And the reason why those top 10% millennials are doing so well is because they're getting a lot of help. They're getting a lot of help from parents and grandparents who are putting down payments on houses for them, and helping them through college, and not take on massive student loan debt, so that when they emerge from those two big things, home buying and college, they're not saddled with all of this debt, right? And they have the ability to then save, participate in the market, earn compound interest, and then all of a sudden you look up 10, 15 years later, and guess what? You have a $500,000 net worth.
I saw a hilarious post on Instagram the other day, and it said, like, hey, when I was 17, I tried to get a tattoo, and they told me, no, you can't, because you're a junior, you're not an adult. And then, like, 3 weeks later, I got a $200,000 loan for my education. So it's like,
yeah,
you're an adult now. Welcome to the world.
Yeah, it's amazing. And I have personal experience with that. I was the first in my family to go to college. Neither my parents went to college. And at 18, I had no financial role model, and these banks were willing to give tens of thousands of dollars to me, right? To go to school. So it is predatory in my mind, and I do have a sympathy for the concept of some loan forgiveness, just because that a lot of these folks who are taking on these loans, oh, you took on the loans yourself, you should have known better. It's like, no, you're 18, you don't know better, right?
At a minimum, I think everyone can agree there should be some more financial education around the effect this will have on you down the road. It's and listen, there's the great conversation at the moment. It's more highlighted by the president and others than it ever has been before.
Yeah, absolutely. And so I just think that all of these things are feeding into the political discourse that we're seeing right now. And the last one is just a basic chart showing that, the red line being income. This is going back to 1985. And this is for a middle class family of 4 versus the median male income. So it's just assuming that one parent, one spouse is working. Can that one income support all of the things that a family of 4 needs? And you kind of see that stopping being possible around the year 2000, and has only kind of accelerated, since then. And I think that this is also something that just furthers, the despair, the sense of kind of always climbing uphill, not having the ability to get ahead, is that, a single income just simply can't afford the
My
basics.
God, it's so interesting. This is a really cool chart for you folks. The first thing that catches my eye, Zach, I'm sorry to
Yeah.
put in here, but we were just talking about housing, we're just talking about education. But if you look since 1985, by far the person, the part of your budget that's grown the fastest, healthcare. My God,
Yeah.
that looks like a 10x. Maybe, I don't know. It seems like it definitely grew to a bigger, bigger than housing, bigger than food. Wow,
Yeah.
really surprising.
Yeah. And,
And maybe not surprising. I don't know.
a lot of that did kind of come around 2008, with the Affordable Care Act. And for what it's worth, the ACA certainly expanded the eligibility of coverage, right? And everyone can be covered, right? There's coverage out there, whereas before there wasn't necessarily.
Yeah.
The problem is they didn't do anything to address cost. And naturally, if you don't do anything to address cost, now you have to cover all of these all of these things. It's going to cost most other people more. I think that there's, the healthcare industry is one that's ripe for disruption. There's a lot of excess and waste, in the healthcare sector, that it's got a lot of regulatory capture. I think I could be wrong on this, but I think it's correct that there's more lobbyists per kind of capita legislator in the healthcare industry than any other industry by far. And so I just think that they have successfully lobbied, to keep costs high, and essentially now a lot of it is subsidized.
It's a
Yeah.
crazy market for sure. And so you spent your 5 charts talking about this kind of dislocation between disenfranchisement from the younger generations from the more wealthy and older generations. Give us a synopsis. What does it mean for investors? What does it mean for us at home?
Yeah, I think it's more not necessarily an investing theme. I think it's more of a political theme, which ultimately does become, a policy which influences investing. But I just think that there's a lot of times you look out into the world and you watch news coverage and you see all of these things happening. You see the polarization in our country. You see folks going to their kind of tribes. And I think that there's reasons for that. It's not just happening. I think that there is primarily an economic reason for it, and that folks just feel like they can't get ahead anymore, and that they can't provide for their families successfully on a normal income. And a lot of these charts and a lot of these numbers would back that up. And I think that just drives people to kind of extreme, not even extreme, but it drives people with tribalism, right? You try to find people who are you can kind of commiserate with and are feeling the same type of way. And then that creates a pole at which there can be an opposite pole, and that's the folks who are doing really well in this economy, and they're saying, well, hey, I'm doing great, my family's doing fine, we're earning more than ever, my business is good, right? And now there's a pole between the two. And I think that's I think it's a lot of what you're saying.
Yeah. And maybe that has existed always at some level, but it's certainly evident at the moment. Yeah, great charts, great comments, and hopefully, folks at home, you found some value. We talk, of course, Zach touched on some of the intergenerational strife. We talked a little bit about where the markets are. Right, there's a little bit of a soft patch here in the last several weeks, but there's some evidence that, well, there's evidence both ways, which is always, I think, a good thing. That things could be tricky over the next 12 months, but we talked our last podcast about how things look pretty good going forward. So we'll continue to keep an eye on things for you at home. We'll touch base with you again in 2 weeks. If you have any questions, please let us know. But thanks for following along. Financial Footnotes.